The world runs on credit. It's a concept that goes back thousands of years. Have you ever heard the phrase, "put it on my tab"? That's a simple form of credit. You get a product or service now, you pay for it later. IOUs were a popular form of payment in the Old West. Credit has become a big part of society. Without it, the economy comes to a halt. But how does credit impact your daily life? That's up next on Fact Bites. If you like this video, please consider subscribing and give us a thumbs up. And speaking of money, check out our episode on how stocks work. We put a link in the description of this video. Most consumers, that's all of us, interact with credit in a few simple ways. Credit cards with everyday purchases like gas and groceries. Auto loans, a means to buy a car with monthly payments. Home mortgage. If you own a home, at least in the United States, there's a good chance you have a home loan. In 2022, about 63% of homeowners in the U.S. had a mortgage. Americans carry nearly $16 trillion in mortgage debt. Some people view credit as scary, with stories of loan sharks and debt collectors. But if you use credit responsibly, it can be a valuable part of everyday life. Now, I have to note, this video isn't designed to serve as financial advice. We aren't financial advisors. But we're going to do our best to explain the basics so you have a better understanding of how credit works. Let's start with credit cards. A credit card is a way to buy now and pay later. Early forms of credit cards popped up in the US in the early 1940s and were mostly issued by local banks to local customers. In 1950, the Diners Club card became the first charge card to gain wide use, and in 1958, American Express introduced its first card as an extension of its traveler's checks business. That same year, Bank of America introduced Bank AmeriCard. IBM introduced the magnetic stripe in the 1960s, which revolutionized how consumers used their credit cards. Following the Bank AmeriCard, Bank of America began licensing its cards to other banks. This eventually led to the Interbank Card Association, which eventually led to what we know today as MasterCard. So how does this impact consumers? When you go to your local bank or sign up online for a credit card, it will likely have a MasterCard, Visa, or American Express logo. In simple terms, the bank issues the credit, but the network that accepts the card and processes the transactions is connected. While this is an oversimplification, for the purposes of this video, all you need to know is that if your card has the Visa logo, it will work at any merchant that accepts Visa. The credit terms are set by your bank. This includes your credit limit and interest rate. Credit cards are a form of revolving credit, which is a form of credit that automatically renews as the debt is paid off. This means that you have access to your credit limit every month. Every 30 days, your bank sends you a bill for the charges on your card. Then you typically have a few weeks to pay off your balance. If you pay your bill in full each month before the due date, you won't pay any interest. A credit limit is a set amount. To maintain access to the entire credit limit, the card must be paid off. For example, let's say you have a card that has a $1,000 limit. In May, you charge $250 in groceries. When your bill comes, you have $750 in available credit. If you pay your balance, you'll return to $1,000 in available credit. However, if you only pay part of your balance, your available credit will be lower than your credit limit for June. If this trend continues, the card will eventually become maxed out, meaning there's no available credit for new purchases. Then there's the interest. Credit cards are one of the most expensive forms of credit, and that's why it's one of the easiest forms of credit to qualify for. Banks know some consumers won't be able to pay, so high interest rates help ensure banks still make money. If you don't pay your balance each month, the bank will charge you interest on the unpaid balance. The interest can really add up. Let's do some math. For this example, we're going to use a credit card with a $500 balance and an APR, which is the annual percentage rate, of 15.9%. The card has a minimum payment of $35. If only the minimum payment is made and no other charges are made to the card, it would take 16 months to pay off the balance and cost about $57 in interest. That $500 purchase would actually cost $557. One more fun credit card fact: Discover Card was started in 1986 by Sears. Yes, the department store. Now let's look at auto loans. You can use a loan to buy a new or used vehicle. Dealerships will even arrange financing for you. But keep in mind, the dealer isn't giving you the credit. They're shopping rates with banks and sometimes financing offers by the manufacturer. Every loan they secure, they get a cut. You can also go to your local bank or credit union to get an auto loan. Auto loans are typically fixed rate term loans, meaning the interest rate is fixed for the life of the loan. This can be anywhere from a year to 6 or 7. You'll often see car commercials advertise 48, 60, or 72-month terms. That's the length of the loan. When you buy a vehicle, all of the fees, taxes, and purchase price are added together. Your down payment or trade-in is then subtracted from the total. The remaining balance is financed with an auto loan. Auto loans are predictable. They have a set monthly payment for a set amount of time, and the interest is calculated into the monthly payment. Auto loans typically have lower rates than credit cards, with rates that are often in the low single digits. If you ever see a car advertised with a 0% offer, that means the loan is interest-free. You'll typically see this when manufacturers are trying to move a specific model. Another thing to look out for when getting an auto loan is whether the loan has an early prepayment penalty. Many do not, which means you can pay off the loan early. If you do, you'll save money on interest. While the interest rate is fixed, if you accelerate your payments, you'll pay less because the outstanding balance on your loan is lower. Home mortgages could be their own video, but we'll quickly cover the basics. As always, consult a financial advisor to determine the best home loan for your situation. Mortgages can be fixed rate or adjustable rate. During times of high interest rates, adjustable home mortgages may make more sense. But over the past 2 decades, fixed-rate mortgages have been popular due to their low cost. Fixed-rate mortgages are typically 15 or 30-year terms, with you making payments each month. The big advantage is that your monthly payment will stay the same for the life of the loan. Now, there are other factors that will impact your payments, such as property taxes and insurance, but the actual purchase payment for your home will remain the same. Like many auto loans, you can also pay more to shorten the term of your loan as long as your mortgage doesn't have a prepayment penalty. Adjustable rate mortgages adjust over time based on current market conditions. You may also see mortgage brokers advertise a 5-in-1 ARM. This is a mortgage with a fixed interest rate for the first 5 years, and then the rate becomes adjustable. Typically, the interest rate adjustment happens 1 time a year. Why would anyone use this type of mortgage? The fixed rate is often referred to as a teaser and can sometimes be lower than a fixed rate 30-year mortgage. If you plan on paying off your mortgage quickly, as in a few years, a 5-in-1 may be a cost-effective solution. The good news with any term loan is that you, as the borrower, should be able to calculate the total cost. Loan paperwork should clearly lay out the purchase price, the term, as in the length of the loan, the interest rate, and the payments. Let's say you buy a $30,000 car with an interest rate of 3%. We're going to ignore the fees and sales tax for this example. Your purchase price is $30,000. The dealer gives you $5,000 for your trade-in. The balance you need to finance is $25,000. With a 60-month loan, your monthly payment will be $449. The total of all 60 payments is $26,953. The total interest over the life of that loan is $1,953, which makes that $30,000 car purchase cost $31,953. The total monthly interest on this loan was $32.55. We hope this information was helpful and answered some of your complicated questions about how credit works. Make sure to like and subscribe and check out some of our other content. Thanks for watching.